Welcome to REBAR Asset Management's Your Money with Danny Stewart.
The market will always overshoot to the downside and to the upside.
And Don Vandenbord.
Because it's not how much you make in the markets, it's how much of that you can keep.
Who is the fool, me or Motley? Now, Motley Fool is fact-checking me from some of the comments I made the last few weeks, but we're going to fact-check Motley. Why? Because it's your money. It's not their money. And are you getting sold by a custodian to an advisor? Are you the product, the cattle, and he's the roper? We'll talk about that and the conflicts of interest there. And never fear, Congress is here to challenge and actually torpedo this new fiduciary rule that everybody's been talking about. And Bennies for IRAs got just a little more complicated. We'll just touch on that. But first, Don Vandenbord just did his initial appearance, his premiere on IBD Live this morning with Webby, aka Mike Webster, aka Webby, and the whole clan at IBD. So Don, how did that go?
It was certainly an interesting experience. They're a great group, very welcoming. I thought the show flowed very well. I got to get my points across and was pretty happy with it.
Oh, it was actually, I watched the whole thing. It was very good. You were right in your element. You're right in there with those guys. I'm sure they'll probably ask you back because it went very smoothly. And Webby was, when you were explaining your our stop loss rules with the combination of beta and ATR, he was nodding his head, shaking along like he got it. He was looking at your spreadsheet when you were explaining the math. I think they're going to kind of look at that. I think they really like that. We're going to talk a lot deeper in that just in a few minutes when we go to the markets. But first is who is the fool, me or Motley? That's what I said. Now, over the last couple of weeks, I talked about my comments about Social Security, about the government stealing your Social Security. Remember, I told you LBJ put it took it from the general fund, from a trust, from a Social Security trust, a segregated account that was supposed to be protected in a lockbox. Remember that lockbox term? Anyway, and then they put it in the general fund so it was used and available for everybody. So now Social Security is going to run dry by 2033. They've got a bunch of IOUs in there, and the money is gone. And so I said, basically, they stole it. Well, not to be outdone, Motley Fool wrote this big, long article claiming that fact or fiction, did Social Security did Congress really steal your Social Security? And it goes, and basically the whole thing is, it says 80% of retirees are going to, 80% of the people, current retirees, are going to be reliant on their Social Security benefit. It's very, very important. Now, the premise, Congress stole the money. Did they really steal it? In 1935, the Social Security Act was signed by FDR, and it has to be put in these asset reserves in these interest-bearing notes, these special issue bonds. So all of the money in Social Security is supposed to be in these bonds paying interest. And one final thing, this article says, the government has never failed to make a payment, an interest payment on Social Security. Well, yeah, it's not out of money yet. Okay. It also says the demographic changes, et cetera, the low birth rates, all this kind of stuff. And it says we're 22 trillion in the hole. And it goes on to all these problems. But the main thing it's saying is, did they really steal the money? Because all this money that they're borrowing and continuing to borrow is supposed to be at interest compounding. Well, here's my problem. In Australia, they've got the superannuation fund. And so they automatically make the employer, the company hiring you, put in roughly 10% in a, like Social Security, in an account for you. Now, different trade groups like the hospitality group has their own union, and this group has their own union. And so different trade unions and different segments of the population, their groups can actually run that fund. The government employees run their own fund, but the whole point is that money is segregated and it's actually invested with investment managers. My sister, who lives in Australia, citizen there, been married an Aussie, lived there for decades, she actually can control her own superannuation fund. She can pick the managers and have it actively managed. So the difference is, and this article talks about a bank, compare it to a bank. When you loan money to when you put a deposit into the bank, they don't just hold it in deposit and don't do anything with it. They go lend it out, and they lend it out at interest. And so he was comparing our Social Security fund just like the bank fund. Here's the difference. When a bank loans out your money, they collateralize it. They get the lien on your real estate property. So they've got a real asset, not just a promissory IOU, a real asset backing that. So the bank is actually getting collateralized a claim on something, and they're investing in something, in a hard asset. You've got that stuff. Here, it's just money in and money going out. They're taking in money from the payroll withholdings, and they're paying it out. And that money that was supposed to shore it up, that was supposed to compound over time to cover the cost as they increased, is not there. It says the surplus that it originally had is not there anymore. That's because it didn't get that compounding effect. They pilfered it. They've taken the money. It's sort of similar, like I've said this analogy before, it's sort of like the roads. The gasoline tax, it brings in hundreds of billions of dollars every year, yet they want to do $1 trillion infrastructure bill to rebuild our roads. Our roads should have already been built with gold. They ought to be paved in gold. They're taking in tons of money, but they're already spending it. It's gone. So yes, technically, I guess you could say that what Motley Fool is saying is correct because the government hasn't defaulted yet. Look, I'm not saying they're going to default. They're not going to default. They'll just print more money and devalue the dollar, and it's inflation. That's the hidden cost. Okay? But it is different. Yes.
You can't devalue the dollar without another currency being valued higher because of currency pairs. So how would that work?
That would work, Don, because you are actually using the dollar to barter against goods and services. So if I've got $1 trillion worth of assets and I've got $1 trillion worth of wood chips that are all flaked together, crushed together, and have a dead president's head on it, and we agree that that's a medium of exchange, right? Like the Indians used to use, Native Americans used to use beads or seashells painted. They agreed that was, because it's not backed by gold anymore. So it's just a
I know, but
currency.
For one currency to weaken,
hang on.
To strengthen.
No. It can also be relative to the goods and services. So if I think about this, if I have $1 trillion worth of these wood flakes that are called dollar bills that we agree on a value, and I have $1 trillion worth of assets, and those are to pay those assets. Forget about all other currencies. We're not doing any international trade. We're only trading here in the U.S. And I print $1 trillion of new money and just stick it in the system. What does that do to the price of those assets? Those assets, it takes more dollars because inflation is only...
Yes, inflation. I agree 100% with inflation. But that doesn't mean that the dollar is going to get weaker against other currencies. But
no, against your purchasing
inflationary.
Power. Against your purchasing power. So I can buy less. So what they will do is through inflation, through printing more and more dollars, making dollars worth less, not worthless yet, worth less, it makes the cost of living go up. That's what has happened here now. So the whole... All right,
I don't know that it doesn't make the dollar worth less, but it makes goods more expensive and you need more dollars to buy them. The dollar only is worth less if other currencies are worth more.
No. If it takes more dollars to buy that specific product, the dollar has lost value relative to that product. It's costing more to buy that product. No supply and demand disruption, no profit margin increase by the company. They're not changing the price. It's only because of the money printing and too many dollars. Okay? So, and look, here's the whole point. The whole point is they say, number one, Americans are not saving enough. We don't save enough. BS. They're mandatorily saving 15% for us, 7.5% as an employee, 7.5% as the company match. So we're saving roughly 15% of our salary up to a cap, yet the Social Security system is out of money. That's because they pilfered it and taken it and spent it. If it was in like Australia's superannuation fund where they couldn't spend it, it was segregated and you could actually invest it in stocks or bonds or other things. It's a different ballgame. So my sister can actually access, when she retires, her superannuation fund, and she can kind of control the growth. More importantly, the government cannot. Here's another thing that you got to remember. If they hadn't commingled Social Security in the general fund and they kept it in that lockbox, in that trust fund, those dollars would not be available to make the debt. That's how LBJ made his budget look so good with his it was called the Great New Deal or something. It was a big socialist program and Vietnam War. The way he made his budget not look as bad is by commingling the Social Security fund with the general fund. Those Social Security dollars are theoretically already spoken for with the liabilities they got to cover, but now you've spent it on other things. If that wasn't available, it would make the deficits look bigger. It would make force Congress to borrow more, and it would kind of hamstring them to be more fiscally responsible. By opening up the gates and letting them have access to all those monies, it makes it easier for them to spend money, just like the Fed dropping rates to zero makes Congress go, oh, well, interest rates are zero. We ought to borrow now because it's cheap. Well, when rates go up, now you got to roll over all this debt at much higher rates, which is the problem where we are now. Point being, whether we're maybe talking about semantics, but Social Security is in trouble and we got to look at some real solutions. We're going to have to look at some kind of cuts. Now, to be honest with you, and if we don't, Social Security automatically has cuts built in. They'll just start cutting everybody's benefits if Congress doesn't get their act together. And folks, look, they don't have to do cuts in Social Security. There is so much wasteful spending in Congress. They could find all kinds of pet projects they could cut and shore up Social Security. But I digress. Point being is, from a very, very technical standpoint, Motley Fool can say that they really didn't steal the money. From my standpoint, they commingled it into the general fund and spent it all, and it's all gone now, and so now they got to borrow even more. At some point, this borrowing and compounding interest expense on the borrowing is going to hit a brick wall, and it's going to be a lot tougher. It's going to slow down growth. Anyway, that's enough of that. Let's go to the next topic, which I really kind of like, and that is, are you being sold? So, like, creative planning. This is a group out of where is it? Let me look. Kansas City. Was it Kansas City or where was it? Anyway, they creative planning came out with this big media announcement. Kansas City-based RIA pays an annual fee to Fidelity of $50,000 a year, plus 0.1, 10 basis points for fixed assets for the client they refer if you do a bond account, and 0.25% for other client assets, meaning if you're doing equities. So Fidelity refers you this client, oh, you look like a good fit, and they refer you to creative planning. Or did you know that creative planning is paying Fidelity a big chunk of money to make sure they get on their preferred list? Fidelity only has a handful. They're the big boys paying the big dollars. So are they really the best advisor for you, creative planning, or anybody else Fidelity recommends? Or is that a conflict of interest? How well is that disclosed? Or do you know that you're being sold to somebody? I'm just wondering. So who do you get your advice from? By the way, Revere doesn't pay referral fees. We don't pay referral fees. Now, I just think that $50,000 plus extra ongoing fees of management is a pretty big incentive to get there. It's not that they can't do a bad job. I'm not saying creative planning can't do a bad job. I'm saying you just got to be aware that there are conflicts of interest with Fidelity and Schwab, by the way, and all these other discount brokerage firms where they're referring you to, quote, an independent advisor. How independent is that relationship, really? Okay.
And
But
ask
the
them what their sell strategy is.
Yeah, right. I actually already know, and they don't. It's a pie chart asset allocation model. Now, Benny IRAs just got a lot more complicated with the new rule. If you need help on that, beneficiary IRAs, inherited IRAs, if you need help on that, call me. And oh, by the way, the new DOL fiduciary rule that I've been railing on for months, it looks like a few people in Congress want to torpedo that. It was a bad bill, poorly written, and how are you going to fix it? Folks, you just got to do your own due diligence. All right. Now, with that, I want to go directly to the mailbag because it goes directly to Don doing his IBD Live appearance this morning. And by the way, we've actually gotten about 10 new subscribers just in the last 15 minutes after Don finished, and 3 of them want to know, are inquiring about becoming a client. So good job, Don. All right.
Boom.
So I'm sorry?
I said boom.
Boom. Mic drop. All right. This is on 516 from WRR from the UK. Dear Don, I've been following Revere for a long time. I'm an IBD and Market Surge subscriber too. Best wishes for tomorrow. This was yesterday. Revere, really educational, and you have informed me a lot. Sadly, I'm in the UK, so our rules mean I can't really invest with you. Very sadly, I spoke with Dan. No joy in the UK and possible tax rise. I'll be rooting for you big time. Very best wishes. Don, thank you for the very kind words. Really appreciate your support. Hopefully someday politicians will come to their senses, but I'm not holding my breath. Take care, Don. Me. Thank you, WRR. We'll be rooting for Don too, and I have all the confidence in him because he is in his element. He's done all the work over the years, done the research, read all the books from the masters, and continues to do so on an ongoing basis to this day. This will make the mailbag anonymously, of course, including my little swipe at the UK. Come on, you limeys, get your act together. And your treaty. It's funny how some European countries are open to U.S. advisors and management. That's fine. But for others, there's significant roadblocks, and some people just say, no, you can't do it. No. Now, most of them will do it with really big tax, makes it tax. They really punish you for doing it, which is the UK stance. So the way it's structured now, you can have an account in the UK, but they're going to tax you kind of heavily. Now, the other thing is, but there are a lot of countries we can do it for. So if you have any questions, just shoot me an email. I just need to know the country, your citizenship, and your country of domicile, your country of residence, because you'd be surprised. They both can be important. All right. Now, this is a little bit longer one, but I want to read this because it really will set Don up into kind of going into his IBD interview today, IBD Live, but also kind of overall arching about how Revere manages money. So, okay. Hello, Daniel. Since your 2 analysts, meaning Connor and Ted, 2 analysts are pretty green in years, I assume you personally set percentage invested funds for your total available. I've seen changes of portfolio tickers on your daily reviews, but not how you're changing the total percentage invested. Can you give me a clue? In other words, is your current stance 80% invested as an example, 40% question mark? What is the process for changes in that percentage? How are you adjusting exposure to risk? From 0% to 100 is the range? Question mark. Do you use IBD Market Pulse guidance? That's what we did this morning. in your own house. Not trying to reverse engineer what you do, just get an idea of risk parameters and see if it aligns with my own state of mind. This guy is actually a very good very sophisticated investor. Then he said, let me see, where did I go? Own state of mind. Let me know if my positions are unclear. And then it goes on to say, I will let Don answer in more details if time permits. He is prepping for IBD Live tomorrow. You might want to catch him if you have a subscription. We do not have access to repost or use later. That's because that's one of their few subscription subscription services that they don't allow you to share. While Ted and Connor are young, I would put them against any 50-year-old at the top brokerage houses and even the most seasoned traders. We have been tracking them and they have been doing well, but only a few clients have even been allowed in their portfolios by invitation only and in limited amounts due to their lack of longer track record, as you noted. Don Vandenbord is a senior portfolio manager who is directing, monitoring, coaching, and teaching them, and who runs GROTECTION, our primary portfolio strategy that all clients have. Then there's a very small select few that I have said that either Don, Ted, or Connor, or Ted or Connor have limited amounts in. But yes, their portfolio, meaning Ted and Connor, but yes, their portfolio must follow Revere's guidelines and rules we have set forth. There is a minimum liquidity for stocks and a maximum position size of 12.5%. That they have to have defined rules we must approve. So they can have their own nuances, but what must be within Revere's parameters. Again, Don is who is going to direct and manage the portfolios with supervision. As far as risk are concerned, we manage risk first and the returns take care of themselves. Each individual position has its own unique stop loss level. That's what Don talked about on IBD Live, and is determined by its ATR and beta, which standardizes each position to have the same effect on the portfolio if the stop is hit. Again, we use alerts, not hard stops, because market makers know where the stops are and they rape the retail investors. And when I say stops, I do not literally mean a hard stop, but an alert, going forward. So then at the portfolio level, that's the individual stocks. At the portfolio level, we have REBAR, Revere Estimated Balance at Risk. This measures how much the portfolio would decline if all stops are hit at once the same day in a massive sell-off. REBAR is currently negative 4.3. Thus, we manage risk at both the individual investment stock level and the portfolio level, because it isn't just about the individual positions, but the correlations between positions in the portfolio. We limit the amount allocated to any sector, i.e. we can overweight, but we can never go all in one particular sector like AI. And we must have exposure in multiple sectors if close to fully invested and not in cash. In other words, if the market's weak, we can always be in cash. That's when you don't want multiple sectors and you don't want diversification. Anyway, we measure portfolios and market in terms of short-term, mid-term, and long-term using moving averages and other technicals. When we break out of the short-term, when we break the short-term level, we will raise cash, normally 15 to 30%, depending on the markets. If we continue to break the midterm levels, we will raise another layer of cash up to 50%, depending. We can do this by selling and or hedging. Finally, if we break the longer term levels, we can raise a lot of cash and could potentially be 100% or even net short if our hedges turn into a moneymaker because the hedge stocks got taken out individually. In other words, we hedge the stocks first, but the stocks continue to go down. Their stops got hit, and now we're left with the hedge only, which is now a moneymaker. So while we may go net short 20 to 40% in a really weak market, we will not go big net short because shorting is much trickier than going long due to strong, violent bear market rallies. By the way, Webby actually Mike Webster can confirm that bear shorting is harder on the IBD Live this morning. We do use Market Pulse, and Don has been formally trained and has graduated from numerous top IBD level courses all over the country. No one knows Market Surge or CanSlim better than Don, in my opinion. But we also use our own in-house methodologies. Our adjusted stop loss is just one example. We have merged some outside technicals that we use with IBD CanSlim methodologies, and it dovetails together, working very well for a nice result. As far as cash exposure, anywhere from zero, rare, but it happens every few years during a bear market or big correction, to almost 100% above 95 with a little cash left over for a final trade or between positions. But as I am sure you are aware, this is very important, folks, the percentage cash does not dictate how volatile or risky the portfolio is. Therefore, we may have 35% cash, but still have a beta of 1.5 or 2 relative to the S&P, which means we could be more aggressive or twice as aggressive as the S&P, even though we have 35% cash, because it depends on the other positions. Thus, the amount of cash, while correlated, does not directly dictate risk in the portfolio. Lastly, we dial up and down the risk all of the time, depending upon the market conditions. It is about market, sector, and individual stock risk, not your risk tolerance. So when the market begins to get ugly and then continues, we will get defensive quickly. When we sell a position, it goes into the Schwab core cash, which only pays 0.5%. If we believe we will redeploy these assets within a week or so, we will leave there. But any excess that appears to build up, we will purchase the Schwab Treasury Money Market Fund, paying for a 5.3%, and that basically is so we don't have a cash drag. So there's lots of ways we manage risk. There's both at the individual level and at the portfolio level. We do use ETFs and we do use stocks. So Don, with that setup, I'm going to let you kind of go over a little bit about what you touched on IBD Live this morning with Mike Webster and the group, and also the overall markets, and any comments on the mailbag.
Dan, that response that you gave is just epic, and you completely summarized our approach. You should pin that, flag it, whatever you need to do, because you'll be cutting and pasting from that for the next couple of years for anybody that asks detailed questions like that.
Shit, I wish you saved it. No, I did.
But the bottom line is, you're exactly right. How much cash you have in the portfolio, or what percent invested you are, is not important. What's important is the overall beta and volatility of what you're invested in. For example, I can say that I'm 50% in cash, but if I have a 50% position in SSO, that's the equivalent of being 0% in cash and 100% in the S&P 500. The difference is we would take that 50% and put it in that money market mutual fund, earning 5.3% interest and generating a nice amount of money every month. So what's important is the number that we show every night in the videos. That's our RVAB number, Revere Volatility Adjusted Beta. The S&P 500 has a beta of 1.00. Every instrument is assigned a beta that compares it to the S&P 500. We take it a step further and add in the volatility of the individual tickers to get a score and compare that score to 1.00. So if the market is weak, we'll be closer to 0.5 or lower. If the market is strong, we'll be at a minimum of 1.0. Currently, we're in the 1.4s, and it can go as high as 2 or slightly above there. We've worked with a data scientist to backtest hundreds of thousands of portfolio combinations to arrive at the numbers that we assign to these individual stocks. It's based on 76% the beta, 24% the average true range as a percentage of the S&P's average true range, because volatility in the S&P impacts volatility in individual names. So the question, it's not the question to ask what percent invested are you. The question to ask is what is the percent in the volatility and risk in your portfolio, and how does that correspond to the S&P 500, and also how does that correspond to a typical portfolio that you might get at another advisor. The beta of a typical advisor, I'm showing here on the screen what a typical pie chart would look like. Now, the beta normally of a 60-40 portfolio is around between 0.6 and 0.65. I'm showing a 3-year chart of the S&P, international stocks, emerging market stocks, real estate, the long bond, broad bonds, and small caps. Far and away, the S&P 500 is preferred. Why would I want to have money just for the sake of diversification in these other asset classes that all they're doing is being a drag on my returns? So I could say I'm 100% invested with this, but that really only equates to a beta of 0.65, and I own garbage. What is the point of that? We're technicians here. Let me bring up a 5-year chart. We look at the chart. We know what's strong, what's weak. Here's a 5-year chart. It's even worse. S&P at 85%. The next closest is Russell 2000 at 36. TLT negative, bonds negative. International stocks only making 25% of what the S&P returned. Why would I want to diversify into an underperforming asset class? It's like eating rotten vegetables to maintain a balanced diet. It doesn't make any sense, and that's not what we do. So the question to ask is, what is the risk in your portfolio? How does it translate to the S&P 500? How does it translate to a quote-unquote broadly diversified portfolio that the typical advisor would have? And then the question, what would you do if the market starts going lower? Because we pull the ripcord and dial our beta up and down, as opposed to the pie chart guys that just, tell you to set it and forget it. You can't get in the way of drawdowns. But I mean, we go on video every night and prove that we can. So that's my answer to that.
All right. Well, hopefully they'll, we'll be able to do a few more of those. Not the IBD Live, but they've got some other formats that are not subscription based that we actually could share if you happen to get on those. But that was, folks, if you happen to have IBD Live, you should go on there and watch it, because they have those all recorded and you can watch the replay. All right. Well, Don, what do the guys have, and what do you guys have coming up?
Well, let's start off with the current state of the market, which is typically what I do for my segment. And we're, after riding this really nice wave going back from November, which topped at the end of March, went into about a 4-week correction. We started another uptrend, and we're participating in this. We got stopped out of most of our positions when we broke the 50-day moving average, and we stayed with a core in the S&P 500 with the intent that we would sell some more of it if we broke below the 100-day or the 20-week moving average, and that's where the market held. So we redeployed into that, back into getting a 0.6 beta, or the equivalent of 60% of the S&P 500, and then adding leading stocks and leading sectors along the way to get our beta up to about a 1.4. And again, we're just going to ride this wave. We don't ever know how far it goes. Today could be the top for all we know, but we've got our stops in place. We raise them as everything goes higher. If something's not acting well, we'll get stopped out. We got stopped out of a couple things that were underperforming earlier in the week. And we're just going to ride the wave. Yes, we have, there's people say, well, you're getting a higher return because you're taking on higher risk. Well, our interpretation of the market based on time-tested historical returns are that there's a time to take on more risk and there's a time to get the heck out of the way. And right now it's a time to take on more risk. And how much risk are you actually taking on if you've got a stop on everything? Like you mentioned, Dan, our downside, if every stop got hit, is 4% to the downside. Or 4.3% right now.
I could give you a perfect example. So look, folks, what these asset allocators do is they forecast going out 12 months in advance, and they give you this asset allocation that they think what's going to happen in 12 months, right? And then they make this allocation for that and set it, forget it. And then they hope that that turns out right. We don't do that. We actually are very different. We measure what is happening while it's happening in real time and make adjustments accordingly, because we don't know, and we'll admit to you we don't know. And I'm a very good economist, and I can make a lot of forecasts, but it doesn't help me to make money. Even if my forecast is right, sometimes that sector doesn't reflect or show up like I think it would. It doesn't react. You've got to separate Main Street and Wall Street, and sometimes a stock is not timely with the economic conditions. Sometimes they don't always move in tandem. But to your point about risk, and this is a true story, folks, we got audited we get audited every couple 4 years, and that's fine, we should. And they sent a person in to come in and collect the data. And she's about 26, 27. They, sent in a young intern, whatever, younger person that just started working there to collect all the data. And they've told her, and she's looking at our stuff, and she goes, "Oh, well, you guys have a lot of trend." This is right after 2022, the COVID bear. This is right at the beginning of 2021. I'm sorry, not 2022. Right after the COVID bear, 2020, in early 2021. And she goes, "Oh, wow, you guys have a lot of transactions. You must be very risky." And so I looked at her and I said, "Well, yeah, maybe the way you guys define risk. You guys define risk as the number of transactions. And my simple mind, I define risk as when I'm in the market, I'm at risk, and I'm out of the market, I'm not at risk when I'm in cash, ignoring inflation. So we measure risk by drawdown of the total portfolio. How much does it go down? How much can it lose? Now, follow me on this. So from high to low during the COVID bear market, right? January and February were very good months. They were up quite a bit, almost 10%, right? Big 2 months. So from the end of February to March 23rd, from high to low, the S&P in 3 to 4 weeks sold off a little over 35%. Boom, high to low. Now, we sold off about 13.5%, so less than half. Now, from year to date, because remember you had two good, so it always depends on where you're counting from. Your time from year to date, the market was down just over 25%. And year to date, we were down 8.3%. So we were down about a third as much as the market. So, and I'm telling this to this girl that's taken all the information. So explain to me if, and by the way, once the market started bouncing, we started getting back in. We always underperform right off the bounce because the way you avoid a big drawdown is by getting out of the way. So you're always going to underperform a little bit off the bounce, but then you can get back in as it confirms an uptrend. So by the end of 2020, we beat the S&P nicely. But the main thing is we missed the huge downside. So you didn't get scared out of your strategy. You didn't get terrified, because everybody, even if someone says they're aggressive, I got a high risk tolerance, they lose 35% in 3 weeks. They've soiled their pants. I'm not sure they're still feeling as bulletproof like Superman as they think they are. Anyway, I told this lady, so explain to me how we're much riskier than the S&P when we went down half as much. Could you explain that to me? She didn't have an answer. So folks, we measure risk on total portfolio drawdown. And like I said before, we got that REBAR, Revere Estimated Balance at Risk. So we know what if everything in the portfolio got stopped out at once, but we also have individual stops on every single position in the portfolio with their own unique stop loss. And that's actually what Don explained on IBD Live this morning, was how we calculate with a combination of average true range and that stock's own beta, how we merge those two technicals together to get a blended, get a number to get. So the bottom line is, if a stock is super volatile, real volatile, it may have a 9 or 10 or even 11% stop loss versus a stock that's not as volatile that has a 6% stop loss. Well, then we adjust the size. You take a little smaller position of the one that's more aggressive, a little bit bigger position of the one that is closer into the stop, that's not as volatile. That way, because we don't know which stop is going to get hit, but either one, if either one gets hit, it has the same percentage and dollar effect on the total portfolio. So in effect, you're kind of standardizing all these different stocks within different sectors and different volatilities, so they're all kind of standardized within the portfolio. It makes it a lot better for risk management. All right, Don, back to you. If you want to add anything on that, or
no, that was great, Dan. Let's go to the guys.
Go ahead.
Start off with Ted.
Yep. So last week, before we made new all-time highs in the markets, we just popped above the 50-day, just about right in that range. And I noticed and pointed out to the team that I saw a kind of contrast between the precedent that we were watching, which was the August 2023 through November 23 correction, and then this pullback. And this was what I showed on the last podcast. I noted that we saw a lot of net lows in that previous correction, and then we started seeing some net highs actually when we popped back above the 50-day in this current rally. And then on the NASDAQ, I talked about how in that August rally, we were extended and moving down below the 10-day moving average into a downtrend, while this time around, we were curling back up the 10-day moving average and moving into the uptrend, as well as from oversold territory into this neutral territory. So Donna, can you pull up the updated charts from this week? So I have the net highs and lows and the NASDAQ as well. As you can see, as you can see on the left-hand side, net highs continue to expand, which is exactly what we want to see as markets move into new all-time highs, because that just means that there are stocks moving with the indexes, and it's not just a few maybe mega caps or larger market cap stocks pushing the markets higher. And it shows that there's health and breadth of leadership currently in the markets. In the NASDAQ, last week we curled up, and now we're actually dipping into or moving into that overbought territory. But as you can see, if you just look quickly to the left, every time you move into that overbought territory, it tends to stay there a little bit because buying pressure is so strong. So that's exactly what we want to see this time around too, to stay in that overbought territory as this market uptrend ensues. Continue on. Don, can you pull up the CNN Fear and Greed? Last week I pointed out how in that August 2023 correction that ended in November, when we first moved back above the 50-day, we were instantly in extreme greed already. So that was one difference. And this time around, last week, we're neutral. And now even into all-time highs, we're just in that middle section of greed, not even in extreme greed. And usually market turns based off sentiment happen at the extremes, which we aren't there yet. So that is constructive to see as well. I didn't put the AAII chart in this segment because I just want to keep it shorter, but we saw the readings maintain about the same levels as last week, even with the markets moving into all-time highs. So that is good to see as well. And then going on to a different subject, I wanted to talk about Bitcoin again, which I've talked about many times previously. We had a huge move. If you look at the weekly chart into the halvening, and after the halvening, we've been basing for about 2 months now. And more recently, we undercut that 60K level if you look at the top daily chart and reclaim that quickly. And that is a really good sign because it shakes out the last week holders. And this is where the strong hands accumulate the Bitcoin or stock of the weak holders. And then you see that move into the EMAs, and it starts to tighten up and build a shelf here. And that indicates more institutional accumulation. And then a few days ago, we had a huge move out of that consolidation pivot, reclaim the 50-day simple moving average and the all-time high anchored VWAP. So just it is really setting up here We've gained exposure through IBIT in GROTECTION. We actually added 1% today off the retest of the 50-day and hold. And now we're still above that all-time high anchor VWAP. And this picture was taken this morning. As of now, we're actually breaking above that blue line that I've drawn around 67,300, or we made a new high above that today. So maybe we struggle there, pause there for a little bit, need to put in another few tight days and move out. Or another situation is that we just run up quickly to that 70 to 72,000 area and build a higher handle. This is something that I've been watching all year. I've realized that some of my best trades, at least, and I'm sure Don and Connor can agree, are the ones that are premeditated and definitely a day before and often weeks and months before. And I've been stocking Bitcoin just for months and months, traded it back in that 44,000 level as well with the team. And I definitely think this is one of the fatter pitches heading into the end of the year.
Great stuff, Ted. Let's take it over to Connor now. He's got a couple of charts to review, including and starting with CrowdStrike, our largest position right now in GROTECTION.
That's right. Yeah. So before I get into those charts today, I wanted to talk about, buying pullbacks. Given like the psychology of buying a pullback, it can be more tough for some people, like Charles Harris, for example. If you have ever seen him on IBD Live, like that's his bread and butter. But for most people, buying strength makes more sense. But I wanted to talk about just a few things that I've noticed and that could be helpful when buying a pullback. And I love this saying, it's nothing like price to change sentiment. And that's just an old Wall Street saying. But whenever the market pulls back or a stock pulls back, you really see that out in full force. Nothing could change besides the price, and the narrative suddenly changes, like from one side of the coin to the other, and people get all worried and all that stuff. So there were 3 stocks that I looked at while the market has corrected a little bit, and they all had pretty similar characteristics. So Don, if you go to the weekly chart of Crowd, and so Crowd was the leader that first coming out of the bear market. So one thing you can check off the list for this stock when buying a pullback is this is a proven leading stock with the fundamentals to back it. And it's proven itself that it can run. And one thing I've been noticing is when you look at this pullback, right, it had that exhaustion top on that earnings kind of gap down. And actually, Don said this word for word on IBD Live today, but it needed a new base, right? So there was nothing really wrong with this stock. It just had a big run, and everything needs to, rest and gain momentum for the next run. But on this pullback, if you look at the volume, it really dried up. So I was telling you, it wasn't really people selling the stock hard. It was more just natural price fluctuation of a stock. And so it was on very low volume, and it held the 21-week moving average. And I went back and looked at the S&P 500 and some other leaders and noticed a common characteristic that most of the leading stocks will hold this moving average in a bull market. And it's like, obviously Stan Weinstein with Stage Analysis talks about the 10, 30, 40 week, but I have noticed that this 21 week tends to act as a good guardrail for a leader. And as you can see, it undercut the 21 week moving average, reclaimed it on volume. And I think the main tell was that the volume to the downside was very light. It was very controlled, and the handle was a very reasonable depth. And as you can see, it's coming back higher. And if you just go to the daily chart, Don, the daily chart looked very constructive as well. You had those daily averages that we use starting to get clumped together, and looking at that volume in the base can be a really good sign. It had that 2 days of above average volume in the base, so that was a good early entry, and that's where we took a starter, and then you can add as it works, because with buying pullbacks, you never know when it's going to stop pulling back. So that's probably the best approach, is when you see that volume, and then you can add as it starts working. Second chart is SMCI. And this one was very interesting when I was looking back at it. If you pull up a weekly chart of SMCI, it just makes it look a little bit more clear. And again, this was one of the strongest stocks in the market out of that rally. And given the nature of this stock, it did have a pretty harsh pullback, but given the stock had ran from 200 to over $1,000 and the ATR of the stock, you kind of have to take that into account when looking at like the pullback and the base. And so, yeah, even on this pullback, it found support at the 21-week moving average, and the volume wasn't exaggerated. It was relatively controlled, and there wasn't any days of above average volume to the downside. When you look at that weekly chart, it found support at that 21-week moving average and is bouncing so far. And yeah, so that's an orderly pullback for this name in a leader, and it's shown some strength recently. So one to watch, and then Eli Lilly is the last one, LLY. And this one, this is just wanted to bring in a slower name to show you how this had a much more controlled base, and that's evident because the stock has a lower ATR and it's less volatile. But this one, it broke out of that base earlier this year, and then it formed a double bottom base off that 21-week moving average, and it still looks constructive in this space. So those are 3 examples and 5 points that I wanted to talk about that from just looking at, how leading stocks acted in this correction that I think are good pointers that I took note of myself is first is sometimes zoom out. Weekly charts can give you a better perspective, and they can and tune out a lot of the noise that sometimes the daily charts can show. And then second, just because the stock is pulling back doesn't mean the story is over. As long as the volume's low, it's respecting the longer term moving averages and like our trend gauge. As long as the stock's in an uptrend and the volume's relatively light, it could be an opportunity into the stock versus, the stock's topping. And of course, you need a bull market behind you to buy pullbacks. Number 3 is keeping a ready watch list of leading stocks during the market correction is crucial, because if you're not watching the stock and you don't have your list of top fundamental stocks, you're not going to be ready for opportunities when they pull back. And as always, there's a key difference between buying a pullback versus buying a falling knife. And any pullback, you want to see an upside reversal on volume. I've noticed that they all do, instead of, you can have your pullback entry and then you look for buying to come in with a strong upside reversal, can give you good odds. So, yeah, those are some pointers on buying pullback, some key takeaways that I took away, that I had myself when looking at some of the leading stocks while the indexes have corrected a little bit.
Great stuff, Connor. Loved how you pointed out the nuances in that base, both on the daily and the weekly, that CrowdStrike was forming. Dan, that's it from the technical side. You can take us on home.
Okay, well, I want to ask a question. You know what I think, folks, we give you the raw data here. This is live drinking out a fire hose. This is not some scripted, perfectly manicured, pedicured, CNBC scripted thing. We're giving you the real data. So I'm actually producing here on the fly. So it's probably, I think every week we should do like a lightning round where we just ask each guy their one favorite position. So I'm going to go to Ted first. I'm assuming Ted's is IBIT, but I don't want to put words in your mouth, Ted. What is your one most, and it can be long or short, what is the best setup that you like? What is this position you like the most right now? Most intriguing?
I'm going to go with IBIT, Dan.
Okay. Connor?
I'm going to go with Pure Storage, PSTG.
PSTG. And Don?
CrowdStrike, our largest position, continues to act well, and we'll stick with that as long as it continues to act well.
That's what I thought. Now, folks, here's another thing I want to talk about before we go. You hear all the people go, the market's at new highs, the market's at new highs. Oh, what are you going to do? You got to yes, you got to protect profits. But don't just think that the market's at new highs, it's about to roll over, and you hear all the fundamentals about how the fundamental valuations are too lofty. Look, I could do fundamentals in my sleep. Yeah, they're very high, but the market is setting up right now technically. Now, a lot of people, and I get even clients call me up and go, "Oh my God, the market can't go any higher than that. It can't keep going up." You've got to be supple enough in your mind to believe that it's entirely possible for the market to go down 20% next month or the next couple months, or go up 20 or 30% in the next few months. So on IBD Live this morning, Mike Webster, aka Webby, actually said that their research is showing that the market is just about to enter, quote, is entering a power trend. That's one of their trademark kind of proprietary things that they've come up with. But what he's saying is it's setting up and it looks like it wants to run. The markets want to run. That's what our research is. Now, this can change next week, and we're supple enough to change our mind next week. But the market looks like it wants to go higher, and it's going higher. The question is, what are you doing? Are you too scared to stay invested because you don't have a sell discipline? You got to let the market dictate what your moves need to be, not forecast 12 months out. Well, that's our opinion at Revere. And speaking of Revere, folks, listen, if you like what you heard, just tell a friend, tell a neighbor. Go in the upper right-hand corner. There's a subscribe button. You can put in your name and email address, and that'll sign you up. You'll get our daily market insights video that Don does every night the market's open. And by the way, clients, once they become a client, go, wow, now I really feel in real time that newsletter's come alive, because now I'm feeling in real time what Don is saying in his nightly newsletter. Because, you know, when you're just getting the newsletter, it's a little bit out there in cyberspace. It's a little esoteric. You'll also get this podcast in your inbox Saturday morning. But if you go to YouTube and just type in Revere Asset and subscribe, you'll get this before the market close on Friday. And you'll get all of our other stuff as soon as we put them out there. It's a little bit quicker than waiting for our newsletter. You can also, and next to that is a contact us button. It'll send me an email. You can reach out and ask me any question you want. And you can email me directly if you want, Dan@RevereAsset.com, Don@RevereAsset.com, Connor or Ted @RevereAsset.com. And you can always, always, always call us old school at 855-REAL-WEALTH. Folks, have a safe and happy weekend, and we'll talk to you next week on Your Money. Not their money, your money.
Because it's not about how much you make in the markets, it's about how much you can keep.